I think it's a little bit late to again focus on inflation now when you just had the most rapid inflation that we've seen in 30 years in headline inflation in the last 12 months. I think that in many respects, this is trying to just catch up with what has happened to public perception on inflation. While we have good, strong spending gains that are stronger, in fact, than the rise in prices, we have real spending gains. What you've seen with consumer expectations and consumer sentiment falling about 24% has very much to do with inflation. The thing that I think that our markets participants have to understand is that in the environment we just had, we could not have had stable prices. I understand it was fueled a lot by fiscal policy and easy monetary policy, that we had two very large supports to US incomes in 2020 and 2021, that it exceeded the rest of the world. And so US inflation is exceeding other developed markets and many emerging markets. But the thing about this environment that we've been in, where the economy has been changing too quickly, that suddenly you get 10 years of growth in durable goods demand in the space of 20 months, that wasn't going to be in an environment where we could stabilize prices. What should the Fed have done? Try to hold everything back? I think at the margin, maybe people believe they could have acted too aggressively. But what's really important is going forward, that even if inflation slows, and that would be our expectation, that will take inflation down to about 3% on average in 2022. The Federal Reserve will still be tightening monetary policy. And what do you see? You see the US dollar rising. Confidence in US policy is going up. That's a little bit like where we were in the taper tantrum period.
To quote the Beach Boys, as we were doing yesterday, even if we get there fast and take it slow, is that in the price? Or should we expect another taper tantrum?
Well, the one thing that I really think we should sort of not worry about is if it's June, July, or August. We're talking about multiple steps to bring us up to a higher base interest rate. And, I think that there should be something said for where we are in the bond market. We are at a 160-ish yield. We were at 190 before COVID hit, right? So after all of this inflation, all of this easing in monetary policy, we have to, again, acknowledge that overall, broad financial markets are not priced for inflation being a long-term problem. Again, that's, I guess, a bit of a risk. But the reality is if we took a look at inflation expectations 5-year forward, that period 5 years from now out to 10 years, when you take all the cyclical distortions out of the economy, inflation's priced at 2.3% for the CPI. That's 2% for the PCE deflator, the Fed's preferred inflation measure, roughly speaking. So all we have done is take long-term inflation expectations back to where the Fed's target is. Now, what happened in that taper tantrum period is long-term inflation expectations collapsed. They collapsed because back in 2014 and 2015, oil was down 65%. Emerging markets currencies from China to Brazil were collapsing on those initial Fed tightening steps. This time around, I don't believe markets are positioned for that quite a severe drop because we'll begin a normalization.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.